Welcome and thank you all for standing by. All participants will be in a listen-only mode throughout the duration of today's conference call. This call is being recorded. If you have any objections, you may disconnect at this point. Now I'll turn the meeting over to your host, Ms. Katie Trescott. Ma'am, you may begin.
Okay, good afternoon, everyone. Welcome to the 4 o'clock webinar, IRS Section 179 Bonus Depreciation and How Tax Rules Impact Your Business's Vehicle Buying Decision. And this webinar is sponsored by Chrysler For Work, which is our little organization within Chrysler Group LLC that supports small businesses, along with the Business Link dealer network that is focused on the unique business needs of commercial small business type consumers. And it's being presented by our own internal Chrysler Group LLC Office of Tax Affairs. Okay, a little bit, if you're a consumer, small business consumer, a little bit about Business Link and that certified commercial dealer network. There are 875 commercial small business certified dealers across the nation, and their purpose is to keep your small business on the road to profitability through special perks and programs from priority sales and service, extended hours, dedicated Business Link staff, free loaners on flex vehicles, shuttle service, and then the enrollment into this program is free. And also the on-the-job program perks, they're provided to registered business entities, and they provide small business owners with allowances like 2-year oil loop filter or up to $1,000 graphic or upfit allowances or Bosch tool packs. So the Business Link dealer network, along with Chrysler Group LLC, Commercial Small Business Organization, and Office of Tax Affairs are pleased to present you or to bring you this webinar, like I said. My name is Kathy Trescott. I manage commercial marketing here at Chrysler Group in Auburn Hills, Michigan. And you need to know that this material is presented for informational purposes only, and it's not offered as legal or tax advice. We're just giving you this information at a really, really high level and hoping that you can, select your best tax business model that helps you to be versed in tax and small business. So you're always urged to seek the advice of your tax advisor, attorney, and or financial planner for specific tax or legal questions. So that said, during this webinar, we are giving away 10 Profitpreneurship books, and they're author signed via a tweet to win contest, or you simply submit a question at the top in the text box on your left part of your screen. And then if you could input after your question, and this is private, put in your email address and you'll be entered to win one of the books. And that way we can reach out to you if you're selected, and it's a random contest. So you can see how to enter the tweet to win. You follow at Chrysler For Work and go to, retweet the hashtag Chrysler Section 179 specific tweet, and you'll be entered to win that way. Or like I said, just enter a question in the Q&A on the left part of your screen along with your email address, and we'll answer some of those select questions at the end of this webinar. And then we'll reply back to you if you have, in fact, been randomly selected to win one of the books. So within the presentation, there's 3 polling questions. These are actually reflective questions, so we're not necessarily looking for an answer for you to, get on that Q&A and answer the question that we have on the screen. We're just asking that you reflect on what the answers are. And maybe pose that towards your business. Am I doing this? Am I spending this? Am I buying, a specific vehicle? It's just for reference, your own personal reference. So we'll move on to the next one. Presenting this afternoon is Nicholas Lloyd. He's a CPA. He's been with Chrysler Group since 2012. Before that, he spent 16 years in public accounting, helping businesses, both small and large, with their tax matters. He received his BBA and his MBA from University of Notre Dame. We have Scott Zierkowski. He's a CPA. He's a tax specialist with Chrysler Group's Office of Tax Affairs. Prior to joining Chrysler Group, Scott spent 7 years assisting corporations and individuals with tax planning and compliance issues. He received his Bachelor's of Accountancy from Walsh College. And we also have Eugenia Kuzmano. She's a CPA, and she's a tax specialist in Chrysler Group's Office of Tax Affairs. She's been with the company since 2010, focusing on fixed assets and depreciation for the past 3 years. Eugenia has been in the accounting and tax industry since 2001. She received her bachelor's in accounting from Oakland University. So we're all thrilled here at Chrysler to have an internal team supporting, this topic and providing some really, really valuable information. So with that, I'll hand it over to Nick Lloyd.
Thank you. Good afternoon and welcome. As Kathy mentioned, we're going to be talking about how tax rules impact your business's vehicle buying decisions, and we're going to be focused on depreciation and especially first-year depreciation taken in the year that you purchase your vehicle. There are several provisions in the tax code around deductions and write-offs for fixed assets, and vehicles being one of those fixed assets. And these provisions some of them are optional and some of them are mandatory. Some of them must be used individually, while others can be combined with other provisions. And a lot of them have thresholds that you have to be under or over to qualify, and a lot of them are changing from year to year. So it's a lot to keep straight. And the reason that they change is politically driven. If the agenda in Washington is to stimulate the economy, get business owners purchasing assets, investing in U.S. property, then they're going to offer generous tax benefits for buying those assets. On the other hand, if the emphasis is on fiscal responsibility and balancing the budget, there's going to be a pullback of some of those benefits, and that's what you're seeing at the end of 2013 with a lot of this talk about debt ceiling and limitations, that the focus isn't so much on stimulating the economy but on balancing the budget. So we're going to talk a little bit about some of those benefits, how they're going away or decreasing substantially. And why is this important? Because cars and trucks are a major expense. They can be a major expense for any business. They're an expensive item, and the deductions associated with these investments is important for any business owner. So tax implications can influence the buying decision. And with that in mind, we move to the first reflective question: what influences your purchasing decision the most? A few answers there, and as Kathy mentioned, it's not something that you have to click on, it's just something to reflect on. And obviously, in this presentation, we're going to be focused on incentives and business allowances, but the point of this question is just to point out that there are a lot of other factors that go into purchasing a vehicle, and tax incentives is just one of them, but it can be a major impact depending on your situation. So next we move into the agenda. As I mentioned, the emphasis of the discussion is going to be around depreciation, and that's the first 4 topics mentioned in the agenda. I'm going to talk about regular or maker's depreciation. Then Scott's going to go into Section 179 expense. Eugenia's going to talk about bonus depreciation and then tie it all together with a comparison of the different depreciation methods. And then we're going to spend a few minutes each on some other topics which may not apply to everyone, but they're important topics to discuss. So we're going to cover leasing, electric vehicles, and some other considerations, including vehicle disposition and substantiation rules. So the depreciation options that are out there, generally when a business incurs an expense, an ordinary necessary expense that is deductible for tax purposes in the year incurred, but if the useful life of the property goes beyond the taxable year, then it must be capitalized, and vehicles fall into that category, so it must be capitalized, and then the IRS sets forth the maker's tables for depreciating those assets, which we're going to go over on the next slide. Next topic is Section 179, which Scott's going to cover. That's an expense deduction taken in the first year. It has to be qualifying property, and it's a substantial write-off, but those limits are going down, as Scott will mention, after the end of the year. And then Eugenia's going to talk about bonus depreciation, which, again, is a first-year write-off of qualified property, but that also is going away at the end of the year, so it's only for property placed in service before January 1st of 2014. As far as regular depreciation, the maker's rates are set out in tables. All vehicles are considered 5-year property, so they use the percentages that are shown on the screen. It's an accelerated method using double declining balance, switching to straight line with the half-year convention. So in the first year, it's treated as placed in service midway through the year, and that's why some of the depreciation leaks even into the 6th year. But most of the depreciation, 52%, is written off in the first 2 years, so it's a pretty substantial benefit having the accelerated depreciation instead of straight line. Different conventions can apply if the taxpayer is in what's called mid-quarter, which is if you had placed 40% or more of your assets in service during one of the quarters of the calendar year, and then you get different percentages weighted towards that quarter in which you placed most of your property in service. So that moves us on to polling question number 2. How often do you replace your business vehicle? Could be every year, or could be 4 years or more, just something to consider. Regardless of how often you replace your vehicle, you have to depreciate it under the maker's tables of 5 years. I promise these polling questions thin out as we move along. As the topics get more interesting, we'll have less polling questions. So the next topic is, even though we have these depreciation tables that allow us 20 and 32 in the first 2 years, there are certain limitations which may decrease the amount that you're able to take. And the IRS looks at vehicles in 3 categories presented on the right side of the screen. And the first category is vehicles over 6,000 pounds, and those are trucks, vans, and heavy SUVs. And the second 2 categories are vehicles under 6,000 pounds, either light trucks, vans, and SUVs, or passenger autos. The reason that the limits are there and they apply to the second 2 categories is because it's generally thought vehicles over 6,000 pounds don't really lend themselves to personal use. So it's assumed that if you have one of these big trucks like a Ram 5500, that you're using it solely for business use and therefore you're not subject to a limit. Whereas the second 2 categories can be used for personal use, and therefore there are limits on those autos as presented in the next table. So you have your 3 categories there. The first is over 6,000 pounds, so you have no limit on those. You can use the maker's rates of 20, 32, 19, etc. And then the other 2 categories in which you are limited to 3360 or 3160 in the first year. So for example, if you purchase a $30,000 vehicle, you generally have expected to take $6,000 of depreciation on that vehicle in the first year, 20% of the $30,000 cost. But if your vehicle falls into one of these second 2 categories, instead of $6,000, you're limited to $3,360 or $3,160. And then similarly, you would expect to take $9,600 in the second year, 32% of $30,000, but you're limited to $5,100 or $5,400. So you're getting less depreciation. Overall, you're getting the same amount of depreciation, even though you're only depreciating $17,000 of the vehicle over the first 6 years. In subsequent years, then you can depreciate $1,875 or $1,975 per year. So eventually, you are able to depreciate the entire vehicle. It's just a much slower timeline over which you take that depreciation. And also, you're probably going to sell or trade in the vehicle before that time. So we're going to have discussion later on the consequences of doing so. Next slide is just a few categories of vehicles that are not subject to limitation regardless of their weight. These are vehicles that are almost exclusively used for business use that really can't be used for personal use. Examples are ambulance, hearse, vehicles used to transport persons like taxi cabs, or vehicles that are modified in such a way that it really can't be used for personal use, like the inside is gutted so that it can transport property instead of people. And then the final slide I'm going to cover is these limitations are 3160 or 3360 in the first year, but they could be even less than that because you have to prorate the limitation by the amount that you're using the vehicle for business use. So for example, if you're only using your passenger auto 80% for business use, instead of 3160 being the first year limit, it's only 2528. And included within personal use is commuting. Commuting to work is not considered a business use, so within that 20% is commuting. So it can add up if you're driving a long way to work each day. And with that, I'm going to pass it over to Scott to talk about Section 179.
Thank you, Nick, and good afternoon to everyone on the call. Before we get into the specifics about dollar amounts and limitations of Section 179, I just wanted to go over a quick overview. So I guess a big question is, what is Section 179? And Section 179 is a tax code section that was created to help small and medium-sized businesses. The section allows you as a business owner to help manage your cash flow by allowing you to deduct a significant amount of the cost, and in some cases all, of acquiring business equipment in the year it was purchased and placed in service. During Nick's discussion of regular depreciation on slide 9, we saw that you're generally allowed a 100% deduction for purchasing a new vehicle. However, that is over a 5-year period. With Section 179, some vehicles qualify for up to a $25,000 deduction in the first year it is placed in service. Therefore, you are allowed a deduction on the remaining basis of the vehicle using the regular depreciation table as Nick spoke to on slide 9. Now that we know what Section 179 is, let's take a look at some of the specifics of the code section. For 2013, a Section 179 deduction is available for up to $500,000. For 2014, the Section 179 deduction is available for up to $25,000. Now, these limits apply to all fixed assets placed in service during the year and are not on a per-item basis. Furthermore, there's a limit in reduction dollar for dollar if the total purchases exceed $2 million for 2013 and $200,000 for 2014. To summarize, in 2013, if you place more than $500,000 of qualifying Section 179 property in service and less than $2 million, you may be allowed the full $500,000 deduction if you make an election on your 2013 tax return, Form 4562. For 2014, the available Section 179 deduction decreases from $500,000 to $25,000, and the limit on the amount of property placed in service decreases from $2 million to $200,000. And I'd like to take a minute just to point out that the decreased deduction from 2013 to 2014 is something of importance for business owners to consider as we're fast approaching the end of 2013. And generally, to qualify for a Section 179 deduction, the property needs to be purchased and placed in service before December 31st, 2013 to qualify for the higher limits. So what deduction is available under Section 179 on specific Dodge, Jeep, Ram, and Chrysler automobiles that we sell? The maximum amount of the cost of an SUV that may be expensed in the first year under Section 179 if the SUV has a gross vehicle weight rating in excess of 6,000 pounds is limited to $25,000. As you can see from the graphic on the slide, the Dodge Durango and Jeep Grand Cherokee, as well as the Ram truck line and ProMaster van series that were on the previous slide, would likely qualify for the $25,000 first-year deduction. It should be noted that the $25,000 limitation also applies to exempt trucks with an interior cargo bed length of less than 6 feet, which would include some of the, if not all, of the 5'7" bed length Ram trucks that we have available. There are also some limitations on the deduction available under Section 179 for trucks, vans, and SUVs with a GVWR rating of less than 6,000 pounds, as well as passenger automobiles. As you can see from the tables below, the limitation for trucks, vans, and SUVs is limited to a total amount of $11,360, and for passenger automobiles, the limit is capped at $11,160 for the first year. Now that we have a better understanding of Section 179, Eugene is going to provide us with an explanation of how bonus depreciation may impact your vehicle buying decisions.
Thank you, Scott. Good afternoon, everyone. The third method that we're going to talk about today is bonus depreciation. And as Nick mentioned in the beginning of the presentation, for 2013, that is a 50% direct write-off of the cost in the first year. This is only available through 12/31/2013. So after December 31st of this year, bonus depreciation will no longer be available, unless the legislature changes. If it does, it may be retrospectively adjusted or modified for future years. However, things have been pretty quiet in Congress lately regarding this topic due to the health care issues, so there's really no way of knowing if it will be reinstated after year-end. Bonus depreciation is applicable to autos, trucks, vans, and SUVs that are driven in the United States, and no deduction limitation for trucks, vans, and SUVs over 6,000 pounds of gross vehicle weight rating of 5. However, as Scott just explained in the previous slide, there is a deduction limitation in the first year that applies for passenger autos and light trucks of $11,160 and $11,360 respectively. So, since the first 50% is an automatic deduction, regular depreciation applies to the remaining 50% of the vehicle. Bonus depreciation is not applicable to pre-owned vehicles. It must be purchased anew. And unlike Section 179 deductions, there is no limit as to how much bonus depreciation an entity may take in a tax year, like the $500,000 amount for 2013 that Scott mentioned. So how does it all come together? Let's take a look at some examples. We're going to compare the depreciation methods for 3 different types of vehicles. The first example is with a luxury automobile. So Luxury Transportation Incorporated is the company. And on April 5th, 2013, the business owner purchased a new passenger automobile for $30,000. Business use of the vehicle is 100%, so no calculation of personal use is necessary. The allowable depreciation for the 2013 and 2014 tax years are as follows. And let's take a look at the different options by column. So the first section, the green box, option 1. In year 1, 2013, the maximum amount of deduction is $3,160 per the table referenced in slide 12. And in year 2, the amount is $5,100. The amounts for each succeeding year is listed in the luxury car limit table. Under option 2, the business owner elects section 179. So for year 1, as Scott mentioned in slide 18, the amount is limited to $11,160. And in year 2, the amount is $5,100. Finally, in option 3, the business owner elects 50% bonus depreciation. Similar to option 2, because it is a passenger automobile, the limit is $11,160 in year 1 and $5,100 in year 2. In example number 2, we're going to take a look at an SUV. So in 2013, the business owner of Trevor's Electronics and Transistors Incorporated purchased an SUV with a gross vehicle weight rating over 6,000 pounds for $40,000. Business use of the vehicle is 100%, so again, no calculation of personal use is necessary. The allowable depreciation for the 2013 and 14 tax years are as follows. Now in this situation, because the vehicle is over 6,000 pounds, we have 4 options. In option 1, regular depreciation is the option elected. And in year 1, 2013, the depreciation amount is $8,000. We take the full cost of $40,000 times 20%, which is the rate for the first year from the regular depreciation bar graph that Nick showed us, to equal $8,000. In year 2, the rate is 32%, so $40,000 times 32% equals $12,800. Again, the rest of the years are calculated based on regular depreciation percentages. Under option 2, we elect Section 179 and can combine that with regular depreciation. So in 2013, first we calculate the maximum Section 179 amount, which as we saw in the previous slide, for an SUV, that amount is $25,000. Then we calculate the regular depreciation amount on the remaining balance of $15,000 times the first year rate of 20%, and that portion equals $3,000. In total, $25,000 of Section 179 plus $3,000 regular depreciation equals $28,000 of depreciation expense in the first year. In 2014, because we elected Section 179 in year 1, we take the remaining balance of $15,000 times 32%, which is the year 2 rate of regular depreciation, to give us a total of $4,800. Moving along to option 3, the business owner elects bonus depreciation. So here we take the first 50%, which is $20,000, plus regular depreciation on the remaining $20,000. So the year 1 rate of 20% times $20,000 is an additional $4,000 to give us a total depreciation of $24,000 in year 1. In year 2, it's based on the regular depreciation rate of 32% times $20,000 of the non-bonus remaining balance to give us a $6,400 deduction. Under option 4, we show a combination of the 3 methods. First, taking Section 179 plus bonus plus regular depreciation. So in year 1, the maximum Section 179 amount of $25,000 leaves us with a remaining balance of $15,000. We now apply 50% bonus depreciation to that $15,000, giving us $7,500. Now we have $7,500 remaining, to which we calculate regular depreciation on. So 20% equals $1,500. In total, $25,000 of Section 179 plus $7,500 of bonus plus $1,500 of regular depreciation equals $34,000 to deduct in the first year. And in year 2, the regular depreciation on the $7,500 basis at 32% is $2,400 of depreciation expense. So as you can see, these tax incentives can be very powerful in the first year of purchase. In our final example, we're going to take a look at a truck. Carson's Construction, LLC, again purchased a vehicle in 2013, in this case a truck with a gross vehicle weight rating over 6,000 pounds, for $60,000. Business use of the vehicle is 100%, so the allowable depreciation for the first 2 years are as follows. Again, we have 4 options because the vehicle is over 6,000 pounds. Under regular depreciation, option 1, in 2013, is $12,000, which is $60,000 times 20%. 2014 regular depreciation is $19,200, taking the $60,000 times 32%. Under option 2, in the first year, we take Section 179 depreciation of $25,000 plus $7,000 for regular depreciation, which we arrive at by taking $35,000 times 20%, giving you a total of $32,000. In 2014, year 2, the Section 179 depreciation is $11,200, which is 32% of $35,000. Under option 3, the business owner selects bonus depreciation. So for year 1, 50% bonus depreciation is $30,000 plus $6,000 of regular depreciation, which is the remaining $30,000 times 20%. And in 2014, bonus depreciation is $9,600, which is the remaining $30,000 of non-bonus basis times 32%, the year 2 rate. Finally, when we combine all 4 methods together, in year 1, we have $25,000 of Section 179 deduction. Again, that is limited at that maximum amount. To that, we add bonus depreciation, which is 50% of $35,000, giving us $17,500. Then, we take regular maker's depreciation, 20% of $17,500, the non-bonus portion, giving us $3,500. So in total, $25,000 of Section 179 plus $17,500 bonus depreciation plus $3,500 regular depreciation equals $46,000. Depreciation expense in year 1. And in year 2, the remaining $17,500 basis times 32% gives you $5,600 as a deduction. Again, bonus depreciation and Section 179 deductions can definitely help to create a large deduction in year 1. And with that, we'll move to the third reflective question. So do you think that your company will fall within the $2 million Section 179 dollar limitation for 2013? As you think through that briefly, I'm going to now pass things over back to Scott, and he'll cover a couple of minutes of the leasing portion.
Thank you, Eugenia. In some instances, it may make more sense or be a preference of a business owner to consider leasing a vehicle rather than purchasing one. And if you do lease a vehicle rather than purchase one, the lease costs are generally fully deductible. However, along with the deduction, there's also something called a lease inclusion amount. If you look at the bottom of the current slide, there's 2 IRS tables that are provided that represent the lease inclusion amount. We're going to focus on the $30,000 value in year 1. So for a $30,000 passenger automobile in year 1, there would be an $8 lease inclusion that the taxpayer would have to include. And if we look at the other table for the trucks and vans and SUVs, for a $30,000 vehicle that is leased and placed in service in 2013, we would have $7 of lease inclusion in year 1. So to put that in perspective, if a business owner had a lease expense of $500 a month for 2013 and the vehicle was placed in service for the full 12 months, they would have a $6,000 lease expense deduction on their tax return and would only have a $7 lease inclusion amount that they would have to pick up. So the net benefit is substantial, and likely almost all of the costs of the lease are deductible for income tax purposes. There's one more point on here, the last bullet point, which is not really an income tax issue, but more of a sales tax issue, but it's also something to consider. In some states, you only pay sales tax on the amount of the monthly payments and not the total vehicle sales price. So, for example, in Michigan, we have a 6% sales tax rate. So if we have a $40,000 vehicle and we lease that vehicle, we have to include the full amount of sales tax broken out through monthly payments. However, in a state like Florida, generally there is only a amount of sales tax placed on the monthly payment. So in that situation where you have a $500 a month lease payment and say the sales tax rate is 6% again for hypothetical purposes, then you would only have $30 a month of sales tax included in your bill rather than the full $2,400 split evenly over the life of the lease where you would in Michigan. So with that, we considered some of the leasing alternatives. Nick is going to take us through a discussion on some of the tax incentives for electric vehicles. Nick?
I'm going to talk about electric vehicles, and they may not be practical for your business because these are generally small autos. So if electric doesn't make sense for your business, you can spend the next 3 minutes entering the Tweet to Win sweepstakes. I know that's what I'm going to do after my section of the presentation. Kathy introduced me to Twitter this week, and follower at @003, and I'm really excited about that thing. So electric vehicles, there is a federal credit of between $2,500 and $7,500 on those vehicles. To reach the maximum amount of the credit, you have to have a certain weight and battery capacity. You can look up every electric vehicle on the IRS.gov website with the link listed there, and it'll show all the vehicles and how much of the credit they qualify for. So, for example, the 2013 and the 2014 Fiat 500e qualifies for the full $7,500 credit because of the battery power. One thing to note on the federal credit, it's only available to the original user of the vehicle, and the vehicle must be used predominantly within the U.S. So in addition to the federal credit, many states have their own incentives for electric vehicles. For example, California offers the Clean Vehicle Rebate Program, which provides rebates of up to $2,500 for the purchase of a battery electric and some other hybrid vehicles. One thing to note about these types of projects, they're often funded by the state, but once that pool of funds runs out and it's not replenished, then there's no money left over. So it's important to keep track of where that fund stands. A lot of states will list how much money is left in the fund. For example, if there was only $25 million in the fund and the rebate was $2,500, the first 10,000 vehicles would get that rebate, but beyond that, none of the vehicles would get the rebate. And the states also have other incentives for electric vehicles. In California, they can drive in the high occupancy vehicle lane, and they can park in certain places for free that other vehicles can't. So there are a lot of benefits attached to electric vehicles, but again, it's not necessarily practical for every business. So with that, I'll turn it over to Eugenia to talk about other considerations.
Great. Thanks, Nick. So a couple other things to consider, which can be very helpful, one of which relates to vehicle disposition. First is the impact of trading in an old vehicle to buy a new one. There is no gain or loss on the trade if it is treated as a like-kind exchange, which is similar type property. And the basis of the new vehicle is the remaining basis of the old one plus any cash paid towards the new vehicle. So a simple example would be if you have an old vehicle, the cost was $30,000 and depreciation expense was $10,000. The remaining basis was $20,000 in the old vehicle. Now the new vehicle is $30,000, but you paid $20,000 in cash. So that $20,000 cash plus the 20 remaining basis of the old vehicle equals your new basis of the new vehicle totaling $40,000. Second is the impact of selling an old vehicle. Now here the gain or loss is the difference between the basis of the old vehicle and what is received for it. So if you're a business owner, here's another great point where you can leverage selling an old vehicle to buy a new one. Another item to consider are the substantiation rules. Owners and employees must substantiate business use of business vehicles, and this is not taxable to the owner or employees. Now, commuting, as Nick mentioned early in the presentation, your drive to and from work is not business use. Other information that you may want to keep records of to substantiate your business use are the date of travel, the designation, the business purpose for driving, and the odometer reading. Now, in conclusion, I know we covered a lot of information today, but you'll need to determine your vehicle needs before the end of the year so that you can leverage these great tax incentives before they expire at December 31st. Keep in mind that the full deduction would apply even if the vehicle is placed in service on December 31st. Tax rules to date do not favor postponement of vehicle purchases to 2014. So as we mentioned, the 50% bonus depreciation ends on December 31st, 2013. And as Scott talked about, Section 179 amounts decrease significantly after the end of the year. Now, of course, each of you will have to evaluate what works best in your particular situation, since the decision about a vehicle acquisition depends on things such as the needs of the business, personal preference on vehicle type, and of course, tax deductions available, as we discussed today. And with that, I think we've got a little bit of time left where we can go through some questions, and I'll turn it over to Kathy.
Okay, that was great. So just a reminder, the material that was presented is just for information purposes only. It's at a really high level. We, encourage you and ask that you, of course, get the advice of your legal or tax accountant. And then we'll open up the box at the top and look at some of the questions that we got. We're going to answer probably 4 or 5 of these questions. If we ask the question that you submitted and answer it, could you please reply or submit your email address so that we can contact you so that we can provide you with the book. So the first question is kind of a freebie. The presentation that was presented will be posted onto the dealers. So the dealer, Business Link Dealer Network, 875 dealers, they have a commercial page on their site. Within that page is a YouTube player. In that YouTube player, we're going to post this presentation with the voiceover, so you'll be able to refer to it. Another place that this will be situated will be on the Chrysler Commercial Vehicles YouTube player, and it's the YouTube URL is /Chrysler For Work. There'll also be some tools on the blog. So following the question slide, you're going to see the URLs in the path for the additional content and kind of where it'll be loaded to. So that answers that question. Let's see what we got here.
First question, what if the equipment is installed in 2013 but the payment is deferred until 2014? The key item there is when is it installed, when is it available for use by the customer, and that sounds like that's not necessarily a vehicle, because the vehicle will be placed in service when you took possession of it. But as far as any other fixed assets, if they're installed and available for use by the taxpayer in the taxable year, then they can be capitalized and you can start depreciating them and taking advantage of any extra incentives in that year.
Okay, and the person that answered or asked that question, can you please, again, submit another question with your email address so that we can get you the book? And then another question, and we got this question at the last webinar, and I appreciate you submitting your email address. Is there an extra incentive for CNG vehicles, which is compressed natural gas?
Oh,
something like a hybrid.
Yeah, there could be. It's the same section of the Internal Revenue Code as electric vehicles, Section 30D, which discusses the standards that must be met. I'm not too familiar with them because here at Chrysler we don't have hybrids. We only have the Fiat 500e, which is electric. So I can't tell you what those standards are, but if you check out Section 30D, it'll go through the standards as far as miles per gallon and things like that have to be met.
Ryan?
I'll go ahead and take this one. Will the information provided today benefit owners of multiple vehicles or all commercial owners, even single vehicle owners? And I guess the big thing there is, yeah, you can apply this to a single vehicle or multiple vehicles. Speaking to the Section 179 limitations, for 2013, as long as you're placing less than $2 million in qualifying equipment in service during calendar year 2013, you'll have that full $500,000 deduction available to you. So at $25,000, obviously you can apply that to multiple vehicles. And there's one other part to that question. Can you back up, Kathy? And there's a second part here, and I wanted to address this because how long will it aid them? The deduction for Section 179 and the bonus depreciation would be for 2013 if the vehicle is placed in service in 2013. As a business owner, what you want to try to do is you want to try to front load your deductions in instances where you have current taxable income to reduce that. So the benefit is you get to use this vehicle over whatever you determine the useful life to be. However, you get a tax deduction for that expense in 2013. So how long will it aid them? That's kind of an open-ended question as far as how long the vehicle will last, but the deduction itself is beneficial to the taxpayer in the current year 2013.
Okay, one last question. I think this was half answered in a different way.
Yeah, does the customer have to take delivery of the vehicle before 12/31/13, or just pay for the vehicle before 12/31/13? Again, the key isn't paying for the vehicle; it's taking possession, putting it in service for your business, having it available to use for whoever's using it within your business, your employees or yourself. So that's the key as to when it's placed in service and what incentives you get with it, not necessarily when you pay for it.
Okay. And with that, I think we've answered 4 or 5 questions. If you have any questions, I know there were some requests probably from some of the dealers looking for this presentation as a hard copy to use almost immediately. The presentation won't be uploaded to YouTube probably until Monday when we convert it over into an MPEG file and then push out to your site. But if somebody needs this presentation earlier, you can email me at ct, T like cat, T like Tom, 23@Chrysler.com, and we'll take care of it. So the next slide kind of gives you the detail and the path for where some other resources are going to be housed and hosted. So again, the ChryslerCommercialVehicles.com, its work tab, it's under the working blog. And then on the blog itself, there'll be a Section 179 Tax Deduction Center. You can kind of see the page down here. It's got some really cool resources along with a calculator that's aligned to the Section 179 matrix that was provided, and that exists on all of the dealers' commercial page underneath tax information and commercial credit. You can go to, of course, any of our Business Link dealers' retail homepage, click on the Business Link logo. You'll end up on the commercial page within their site, and there are some resources for small business owners above and beyond just the Section 179. It shows you all their inventory. It was built to service small business owners. It's like the one-stop shop for anything related to small business consumers and their vehicles. And then, of course, the YouTube channel under Chrysler For Work, or youtube.com/Chrysler For Work. On Monday, we're assuming we'll be able to load, again, the video of this webinar along with the voiceover. So we hope you got a lot out of this presentation, and I thank Eugenia and Scott and, of course, Nick for their help today presenting this and pulling all of this great information together. We hope you, and we expect that you found it valuable. Again, seek the advice of a tax consultant or an attorney or an accountant for your specific tax needs. But have a nice evening, and then we'll make sure that we present this again next year with the new, hopefully the new limits, and hopefully they kind of stay intact, but who knows. But have a nice evening. Bye-bye.
Thank you. That concludes today's conference. Thank you all for participating. You may now disconnect.